loan may be a customer for business loan also or a home loan also. Of course, there are some synergies across businesses also, but there are a lot more synergies within each of them. And at the same time, when we do the cross-sell or a referral, all our arrangements or agreements are at arm's length, and the referrals and cross-sell opportunities can come from outside the group also and inside the group also. They get paid based on the fair market price and practices. Now, we look at this from the shareholders' perspective. So we have invested in our key subsidiaries as well as our parent company or the current listed company. Fairfax is there, and then we have General Atlantic in our wealth, and we have CDC in our MBFC company. Our agreements with these investors actually provided us with almost about 7 years to give them an exit, and which was not necessarily listing of the three companies. But so the demerger or the reorganization is not being done to provide an exit, because I don't think that is imperative at this point in time. But from a longer term perspective, most of the financial investors have different objectives, different theme of the fund, and they get attracted to different kind of businesses. So there are many investors who are very keen to invest in asset heavy businesses, and there are many investors who are willing to pay extraordinary premium for high ROE or high growth businesses. So once the companies are listed separately, they can attract different sets of investors, and that in a way makes sense for all of us. Now, amongst all the businesses, some of the analysts may have concern about the size and the liquidity of various businesses, and in particular, IIFL Securities, which may be relatively smaller than the other two businesses. But even IIFL Securities business, if you extrapolate the first 9 months profitability, then post-tax profit will be something like close to 225 crores this year, which I think will place it in, say, top 200 or top 300 companies in terms of profitability after full payment of tax, the point that I'm trying to drive home is the business is large enough, all three businesses, including IIFL Securities. And the volatility or cyclicality of earnings of IIFL Securities, I think in the last 2-3 years, a lot has changed. The securities business was volatile for 2-3 reasons, and why fundamental changes will make it a little different, the retail side of it. One is that the business was overly dependent on foreign investors, and what we have seen in the last 1.5 years, that there's a significant flow of domestic money. And an event like this, which we have seen budget yesterday or today, probably would have caused volatility of 3, 4 or 5%, but what we are seeing now is 1.5%. But more importantly, mutual fund has emerged as a very important asset class, and systematic investment planning that we have seen, and many of our investors that we have seen that even in the worst of the markets, we don't see any redemptions or cancellations, at least from the retail investors. Apart from that, in last 20-23 years, we never had any occasion where any business, any one of the business has to be critically supported by any other business in terms of capital or liquidity or finance. So all the businesses have been independent, and they have the ability to stand on their feet. But in terms of ownership, control and synergies or the promoter group, so me and Venkat will continue to be promoter for all the three businesses, and all three will carry the brand name IIFL, and to that extent they are part of the same group if you look at the ultimate ownership or control. In terms of control, my own belief is that maybe in 80s, 90s or earlier, we used to see conglomerates where intertwined ownership or a very convoluted structure will allow the promoter to control several companies through the parent company. But I think that is giving way to the new culture where small, nimble, innovation, idea-driven, independent enterprises do far better. And more importantly, all the regulators, and that we have seen even in our RBI audit, they encourage to have a clean, clear, differentiated structure so that the risk is also contained, as well as it becomes very easy for the analysts and regulators or investors to understand the businesses and take their call on the same. Also, related party transactions we always kept at arm's length, and when we see there are a lot of stringent guidelines about related party that comes in the Companies Act or law, is also primarily to address the issues that have arisen in governance when the corporate structures have been very convoluted or complex and intertwined. So we believe that these businesses that are distinct will also have a lot more transparency for the outside world, public, media analysts, as well as regulators, and we should and that's the way we would like the businesses to be. Also, technology and digital challenges require very quick response. And if the management teams are independent, our response time can improve because, as I said, that even the regulatory approvals will become related to the business and not for the entire group. And with this, I'll hand over to Prabodh, and I'll be happy to take questions later. Prabodh will take you through our financial numbers and the business performance in the last quarter, 9 months. Thank you.
Yeah, thanks, Nirmal. We are very pleased to report a 36% YY growth in our group net profits to rupees 301 crore for Q3 FY18. Net profits after minority interest have grown by 32% YY to rupees 236 crore. Our net worth has reached 4,970 crore. ROE was 19.4% and ROA was 2.4%. All the three segments of the company, that is NBFC, Wealth and Capital Markets, contributed to this strong growth. On the NBFC, our loan AUM grew 29% YY and 5% QOQ to rupees 27,288 crores. Profit after tax grew by 30% YY to rupees 145 crore. The NBFC's net worth is rupees 3,848 crore. Our Tier 1 CAR stands at 16.8% and total CAR at 18.2%. Thus, we remain well capitalized to meet our growth requirements. Our AUM growth is driven primarily by small ticket home loans, which grew by 61% YY. The other fast-growing segment was small ticket SME loans, which grew by 98% YY. Capital market loans declined by 31% YY as prior period AUM included short tenure IPO funding. CV, gold and construction finance segments were other drivers of AUM growth. In home loans, our focus remains primarily on the self-employed section, which contributes to about 60% of our loan portfolio. The fastest growing segment in home loans is the affordable home segment with average ticket size of 10 to 12 lakhs, termed by us as Swaraj loans. Nearly 20% of our incremental quarterly home loan disbursements are as Swaraj loans. Growth in LAP book continues to be moderate as the segment is relatively less attractive due to yield compression. Within construction and real estate finance, the mix continues to shift towards construction finance for small ticket housing projects. As on 31st December 2017, we had nearly 5,500 approved housing projects, up nearly twofold from 3,100 approved projects a year back. All our construction finance loans and 50% of home loans were made through these approved projects. We expect that this approach will reduce our operating and credit costs going forward for our housing finance company. We believe that the overall portfolio risk is on the decline as our portfolio mix continues to become more granular with greater share of small ticket home loans of size rupees 10 to 12 lakhs and SME loans of similar ticket size. The increasing granularity is driving down portfolio risk while at the same time helps us derive better yield versus large ticket lending. Retail loans, including consumer loans and small business finance, constitute nearly 85% of our loan book. Another strong characteristic of our loan book is the large proportion of loans that are compliant with RBI's priority sector lending norms. About 85% of our home loan, 60% of LAP, 90% of commercial vehicle, nearly 30% of SME, and nearly all of our MFI loans are PSL compliant. In aggregate, nearly 40% of our loans are PSL compliant, which we can sell down to banks at attractive rates. The share of securitized book stands at 14% of our AUM, and our aim is to take this up to 15 to 20% of AUM through higher sell downs of home loans, LAP, CV, and SME loans. This should positively impact our profitability and CAR. Our average cost of borrowing declined by 10 basis point Q1Q and 90 basis point YY to 8.4%. Incrementally, we are now borrowing at an average cost of 8 to 8.1%. MCLRs of a few banks have risen marginally and bond yields have risen by 50 to 60 basis points over the last 4 months. Our endeavor is to lock in longer tenure funds at fixed rates. Our NIM was at 6.7%, a decline of 47 basis point Q1Q and up by 35 basis point YY. Falling borrowing costs and rising share of high-yielding SME, gold, and MFI loans have helped support our NIMs. On the other hand, the rising share of lower-yielding retail home loans had a downward impact on the NIMs. The NIM was also lower due to one-time impact on account of premium paid on buyback of old debentures with higher yield from the secondary market. We bought back debentures of the face value of rupees 851 crore with coupon of 9.2 to 12% and remaining tenure of 4 to 9 months, on which we paid a premium of rupees 10.09 crore. That has hit our interest expense. Cost to income ratio was at 38.1% and OPEX to average loan book ratio was at 3.23%. Many of our small ticket loan products are OPEX intensive, including gold, MSME, and microfinance. As the share of these products rises, it puts an upward pressure on operating costs. Still, we believe that there is significant scope for cost ratios to fall due to operating leverage and benefits of digitization. NBFC headcount grew 19% YOY and the number of NBFC branches has grown to 1242 compared to 998 a year back as we added branches in our HFC, gold and MFI business. Our GNPAs were at 2.1% of loans and net NPAs were at 1.2% of loans, both stable Q on Q. Sequentially, NPAs increased primarily in the real estate finance segment. NPA ratios in all other segments were flat or declined Q on Q. Some update on digitization and analytics. We have continued our focus on digitization with more than 97% of 5.16 lakhs loan onboarded in the last quarter onboarded digitally. More than half of loans in December 17 were onboarded in paperless mode using e-sign. This has increased from 37% during the last quarter. eKYC penetration has also been increasing across all products with more than 90% of loans booked using Aadhaar-based eKYC. With 55,000 mobile app downloads in Q3 and cumulative 2.15 lakh downloads, IIFL Loan mobile app is fast becoming the channel of choice for customers for both servicing and account management. Customer acquisition digital finance vertical has tripled from 16,500 in Q2 to 56,000 in Q3, where customers have been acquired digitally and with straight-through paperless process. We are continuously sharpening our cross-sell efforts through analytics driven by pre-approved offers. In the last quarter, we have pre-approved campaigns on over 2 lakh customers. This is a steadily increasing stream of new business and will continue to scale it up. We are leveraging risk analytics to screen new applications at the point of onboarding as well as raise proactive trigger alerts on the portfolio. All small ticket SME loans are onboarded using scorecards and the focus is to create completely automated processes for small ticket loans. Analytical triggers are also being used for fraud auditors and inspectors to significantly increase coverage and detection rate. An update on the wealth management business. IIFL Wealth PAT grew by 54% YOY to rupees 100 crore. Our assets under advice, management and distribution have grown 58% YOY and 9% Q on Q to reach rupees 1.28 trillion. We have excluded offshore FPI advisory assets from our total assets in this quarter, given their negligible contribution to income. It should be excluded from here on. We hired 35 RMs during the quarter. Sorry, that's 34 RMs during the quarter, taking the total number of RMs to 317 to further drive the growth momentum. IIFL Wealth offers a broad range of products and services to participate in a larger share of the client wallet. This includes financial product distribution, advisory, brokerage, asset management, trade solutions, and estate planning. We raised net new money of rupees 17,991 crore in 9 months FY18 versus rupees 15,767 crore in the same period last year. During the quarter, the team garnered AUM in wide-ranging products, including rupees 2,800 crore in focused equity AIFs and rupees 200 crore in focused debt and equity mutual fund products. In our AMC in India, we have raised a further rupees 3,200 crore in our Special Opportunities Fund, which invests in pre-IPO and IPO situations. The total commitment in these funds is now over rupees 7,300 crore. AIF assets grew 30% Q on Q and 63% YOY to rupees 11,600 crores. Total assets under management in our AMC is now at rupees 26,165 crore comprising of rupees 13,494 crore in our domestic AMC and rupees 12,670 crore in our offshore AMC. A new fund, Affordable Housing Fund, was launched in this quarter, which has received good response with an initial commitment of around rupees 860 crores. IIFL Wealth Finance, which offers loan against securities and margin funding to high net worth clientele, grew its loan book 21% Q1Q and 100% YY to rupees 5,847 crore. Average lending rate for this book is around 10.3%. Net fund-based income was higher in Q3 due to reversal of the one-time mark-to-market loss of rupees 15 crore on investments, which had correspondingly reduced the income in the last quarter. Effective tax rate for 9-month FY18 was about 24%, and for the whole of FY18, we expect the effective tax rate to remain in this range. An update on the capital markets. During the quarter, our average daily cash turnover was up 45% YY to rupees 1,411 crore. Our average daily total turnover, including F&O, was up 71% YY to rupees 14,924 crore. Our NSE market share in this cash segment remains around 4% and total around 2%. The investment banking team completed 11 transactions during the quarter, including 5 IPOs of HDFC Life, Reliance MF, Indian Energy Exchange, Future Supply Chain Solutions, and Shelby Multi-Specialty Hospitals. There is substantial pipeline of transactions in various stages of execution. I think that ends my opening remarks, and will now open the floor for Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question at this time, they may please press star and 1. The first question is from the line of Pawan Ahluwalia from Lebanon Capital. Please go ahead.
Thank you very much, and especially good to have Karan on the call this time. My questions have to do with the wealth management side of it. Karan, we've discussed on previous calls what the best way is for us to be thinking about this business going forward, and would be good to get some of your insights on how we can think about it more granularly. It seems that you basically have a team of bankers who go out and gather assets from clients, and the total solution that you present to a client obviously has different margin profiles depending on what the asset is. So if you're helping them allocate into a mutual fund that's managed by somebody else, there's a certain margin on that. If you're allocating them into an IIFL mutual fund, that margin is obviously higher. If you're in an AIF or more exotic product, I'd imagine the margin is, highest of all. Is the right way to think about this basically to assume that each banker has a certain kind of revenue generation target that's some sort of multiple of their salary, and they're expected to get it by achieving some sort of blended margin across the pool of assets they sell to clients? And so, if we had to break down your model in operating terms, the way in which you grow is basically bringing more and more managers onto a platform, because for each banker, there's a certain, there'll be a handful of superstars who can do, very large tickets. But for most bankers, they'll probably peak out at, at a certain revenue size, and beyond that, you need to get, more people on the platform. That's my first question. And second, if you look at the team you have today, how far away is the existing team from, achieving peak revenue targets? In other words, what's the sort of operating leverage you have with the existing team and the existing cost structure versus growth that you would need to get by bringing other people onto the platform?
Good. Thanks. So I'll quickly take the first question. Broadly, the way we look at our business, first of all, is divided into two big buckets: the wealth management business and the asset management business. Within the wealth management business, the focus is primarily on four activities. The first, as you rightly said, is distribution of financial products, which is today become a fairly broader term. It's not restricted only to mutual funds. It includes portfolio management schemes as well as alternative investment funds. And high net worth individuals whom we cater to typically want to look beyond mutual funds, and therefore the net market share or the net new money coming into financial products are more driven towards alternative investment funds and PMSs as compared to mutual funds, which possibly was the trend 2 to 3 years earlier. The second core activity is that of advice. Advice is something which is a little more holistic in nature, where it starts from asset allocation all the way to portfolio construction, setting up an investment portfolio mandate, and so on and so forth. The third service we provide is that of execution, which is, in a sense, becomes a byproduct of the first two, because the clients would typically come to you for a financial product or for taking advice, typically end up doing some bit of execution with you. And fourth is the clients who've, over a longer period of time, built a large amount of faith and trust and essentially start giving discretionary mandates, either through a portfolio management scheme or through an alternative investment fund. So these are the four segments or four levels of engagements which we have with clients. On the asset management side, we focused a lot on the alternative investment funds as compared to the PMSs and mutual funds. Within alternative investment funds, our commitments would be in the region of 15,500, 16,000 crores. The amount which is drawn down by clients is 11,300 crores. That would make us possibly the largest player on the alternative investment fund industry. And the other parts of the business, which is around corporate finance, estate and tax planning, essentially, and the NBFC, which is the lending business, essentially serve as conduits to our wealth and asset management business as supporting levers to enable us to service the clients on a holistic basis. So that's pretty much from a business perspective. In India, currently, from a fee perspective, clients look at distribution advice and discretionary asset management fees and execution fee all pooled together. They're very, very well aware of the fee they are paying, either whether they're coming into an alternative investment fund or in a mutual fund, and pretty much are broadly okay with the fee, whether it's coming through either advice or it's coming through distribution fee or it's coming through brokerage. On the model itself, we do not specifically only have a revenue target for every banker. Banker's dashboard is essentially made up of three big line items. One essentially is the assets or the book he's able to build up. Second is obviously the quality of assets in terms of what are the assets which for example, we differentiate between money market instruments and other mutual funds or alternative investment funds, where the client is most likely to have a longer tenure of investing. And third is essentially the revenue. So these are the three combinations which essentially enable the performance of a relationship manager. In terms of the peak capacity, really, if you see our business, assets are increasing twofold in two segments. Essentially, one is what is money which is new to the industry itself. Now, new money to the industry essentially comes out of either sale of a business, where a promoter is exiting part of his liquidity and ends up with a new pot of money, which he is not yet decided to invest in another business. Or let's say it could be sale of property or sale of stock options and so on and so forth. So this is money which is new to the industry itself. And second kind of money is obviously money which we are moving from competition or where a client has decided to start with us, whereas earlier he was dealing with other players. We've seen a big growth in both the categories. In the first category, obviously, I think there's been a great level of activity for the last 6 to 7 years. The second activity is obviously largely driven by the number of bankers you add from your competitors, because that's the best way to access the client. In terms of where we are in terms of the peak capacity, I think that's a very good question. We essentially run something called a RM relationship manager build-out model. And we typically see the relationship managers breaking even somewhere in terms of assets between the 18th to the 24th month. and between the 24th and the 60th month, they are pretty much move into a good degree or 60th to 70th productive percentile, and north of 4.5-5 years they become super productive. And if you see the vintage of our team, the operating leverage will, if you see the RM vintage, and we can send across a chart, our average vintage is around about 2.5-3 years. So the real curve in terms of the 3 to 5 year increase is something which we are really looking forward to, because a large part of our team has come in over the last 2.5-3 years, and most of them have already crossed the phase of breaking even and becoming profitable. But over the next 2 to 3 years, we see them really kind of scaling up. So as such, the larger part of the team, the RM vintage is in the region of 3.5 years. For the older guys, the attrition continues to be next to negligible. Out of our 70-75 senior bankers, over a period of 7 to 8 years, we've only lost a couple of bankers, and that obviously allows your platform to be fairly steady and stable.
Thanks. Thank you very much. Just one quick follow-up on that, and that chart would be greatly appreciated, I think, by all investors. If I look at the assets overall, that's obviously slowing down as you'd expect on a high base, but the AIF piece has really grown very significantly, and that's bound to be much higher margin, than the overall revenue margin. You're also at a pretty high base on AIF now relative to what's been seen in India so far, and you're certainly the leaders in the industry. Any thoughts on how you're able to grow the AIF piece from here, either in terms of new products that people haven't seen before, or what's the vision around that piece?
Well, I think there will be a lot of innovation on the alternative investment funds piece, and it's actually happening through two or three reasons. One, I think we're getting a great degree of new independent managers who've got proven track records for 5, 10, 15 years, moving out of their own comfort zones, either sitting on mutual fund platforms or otherwise, and wanting to manage money independently. And they obviously look to distribution platforms like us to partner with, to go out and raise money from clients. They are able to kind of do a lot of innovative structuring, either on the construction of the portfolio or possibly on the fee structure, or so on and so forth. For example, we launched a manager recently where the profit share was only above the performance of the CNX 500. So there was a little bit of innovation on the fee structure. So I think innovation will guide the growth of the AIF market in a very, very large way. And I would tend to believe that it's only the start. If you see across the world, I think alternates as a broad category, and I'm using the word loosely, alternates, has grown to become among the largest kind of categories. And there is fair degree of tax clarity now over the last year and a half, which was not there earlier. And I think that, together with the ability to innovate, will lead to a lot of growth in this category over the next 3 to 4 years. As a category, if you see, if you look at equity and real estate and credit, even if I exclude category 1 in alternative investment funds, it's around about a $10 billion industry. Compared to mutual funds, and I'm removing money market funds and short-term funds, it'll still be around about only 5% of the money in the mutual fund category. So I think it's got a lot of space to grow.
Thank you.
Thank you. The next question is from the line of Viral Shah from Credit Suisse. Please go ahead.
Hi, thank you. Good afternoon. This is Sunil Tirumalai from Credit Suisse. So I have a couple of questions. Firstly, on the demerger and the listings. While I hear you that even earlier you had arm's length transactions, related party between the entities. You would agree that there will be some loss of soft synergies, right? For example, maybe the wealth management business was using your research product, or that there would have been a lot of close linkages between your capital markets team and the NBFC team, the lending team. And now when split everything into 3 independent businesses, will there be any loss in franchise or loss in those synergies and working together? If you could elaborate that.
I don't think there'll be any loss in franchise as such, and loss in synergies or whatever. As businesses grow larger, all the businesses need independent, all these common facilities like maybe CFO, CTO, all the departments. And not only that, the technologies that are used are also very different. And so there may be small cost savings if you work together under one roof, but I think it's very insignificant in the overall scheme of things. And compared to, the benefits far outweigh the small synergies or cost. They're much smaller than what it appears from outside. So, because every business has its own critical mass and they can deploy and have their own support functions and, the facilities. So, it is not significant at all.
Got it. And just one more clarification. So the brand name IIFL, would it be owned by somebody or, will it be shared? I just wanted some clarity on that.
So the IIFL brand is owned by a holding company as of now, and there is a license to use it without any cost with these two entities. So now once there are three entities, all of them will be using IIFL brand.
Got it. And my next question is to Karan. Sir, just wanted to understand, how do you think, if SEBI eventually pushes this regulation of splitting the advisory and distribution functions, how do you think the industry and, yourself, will look at it? I mean, because it seems, quite a structural change if that does happen.
So to be honest, there's a circular which came out around about 4 weeks back, and we've had an opportunity to interact with the regulators on the same and other industry participants also. So the regulation in the current form essentially suggests that if you do either advisory or brokerage, you can't, or distribution, you can't do the other. As of now, for the last 1 odd year, we've been organized in a way where the advisory business and the distribution business are distinct. In case the circular was to come through in its current format, I think more or less all of us will be forced to become brokers as opposed to becoming advisors. And whatever advisory business we intend to do, whether in the format of asset allocation, investment management, all of that essentially will happen only if the client signs a discretionary mandate with us, which will happen through the portfolio management umbrella. So really in that sense, the business will be reorganized in two formats. One is the financial product distribution, brokerage, and the discretionary portfolio management business. Today we have 4, which is brokerage, financial product distribution, portfolio management, and advisory. From a revenue stream today, clients hardly pay any advisory fees. So if you look at our revenue stream, less than 0.1% of our fees would be coming from advisory. So from a revenue impact, it will be negligible. But from an offering perspective, we may have to move some of our clients from advisory to discretionary. So I really don't see a very large impact if it comes in the current form. But whether it comes in the current form or not is something which we'll have to wait and see for the next 3 to 6 months. But we are fairly well organized from a structure perspective either way.
Understood. Got it. And does it help that you also manufacture some of your own products?
So world over, actually, if you see US being the best example, where you've seen a large part of the business over many, many years with the regulator allowing both to coexist, which is broker distribution and advisory. Over a large period of time, we've seen 40 to 50% of the assets actually translate or migrate from brokerage to advisory. And in that context, I think having 3 or 4 things in-house has been the most important. One is obviously having your own innovative products on the asset management side. That makes a distinctive advantage because you can offer a preferential fee structure for clients who convert to advisory. Second, the concept of an all-in fee, where essentially you're able to subsidize the transaction fee on account of the advisory fee, is again been a very big operating lever for moving clients from broker distribution to advisory. Unlike most other competitors, we have the advantage of having a brokerage license within the wealth business itself. Third operating lever has been the NBFC, where you essentially been able to help clients borrow a part of money against their portfolios at fairly attractive rates. And these three things put together, being within the same business, will give us a fair competitive advantage in case these regulations come in, to be able to slowly move clients from distribution to advisory, if that's what's required. In the current format, it will be more distribution and discretionary as opposed to distribution and advisory.
Got it. This is very helpful. Thank you.
Thank you.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. The next question from the line of Saurabh Dole from Trivantage Capital. Please go ahead.
Yeah, thanks for taking my question. Firstly, on the corporate restructuring, what kind of timelines are you looking at?
So, it requires regulatory approvals and NCLT, which is now surrogate for High Court, and then again regulatory approvals. So it can take about 8 to 10 months.
Okay.
But what happens is that in the scheme, you provide for an appointed date. So we intend to provide for an appointed date of 1st April 2018. So whenever an approval comes, then you recast your balance sheet and it's effective.
April 1st,
Assuming the approval will come after 8-10 months, the final one, and the listing. So then it will be effective from 1st April 2018.
Right.
But the process may take up to 10 months. So.
Okay, and on your NPAs in the construction book, there's been a very sharp increase, if I may call it. So I just wanted to understand, as in the QOQ movement, moving from 1.4 to 2.3. So if you could just elaborate on the granular details of this incremental growth in NPS.
No, so this is construction finance. So they are basically builders. I mean, we have, and so some of them basically and now we are on 90-day provisioning and a NPA recognition norm. So many times, even if people have temporary cash flow problem, they have to be recognized as NPA. So there are some chunky cases in this which have turned NPA in this quarter. But in all these cases, typically we have adequate collateral and we should be able to recover our money. Either the borrower itself regularizes or in an extreme scenario we liquidate the collateral and get it. But as far as accounting is concerned, if the interest is not paid for 3 months, it becomes an NPA.
Okay, and in terms of the mix between affordable housing builders and non-affordable housing builders, any sense on that?
So, in terms of incrementally, it's predominantly affordable housing.
Okay.
And so total, how much is the total book? Prabhu, you want to give numbers on this? Just
Yeah. So our total home loan AUM is 7,500 crores. And out of that, about 20% is, the 20% of the incremental, and about 10% of this is affordable. So about 800.
I think this question is you want to know the construction finance to affordable category and non-affordable category, right?
Exactly. I want to know the mix between affordable and non-affordable construction NPAs.
Construction NPAs?
Yeah.
Oh, that's very, I think it'll be significantly. First of all, non-affordable itself is not very clearly defined term, but supposing we look at the premium residential or maybe the larger cities which are larger value projects, then the most of the NPAs are from the larger projects.
Okay.
But incrementally we are doing more of smaller projects, but these are loans which have been carried forward for some time.
And so just one last question on this CV book, the growth rate, though obviously better than what we have seen in the previous quarters, but overall, with respect to the rest of the players, are you of the opinion that you are growing a little more cautiously than the others?
I don't think so, because our growth in last quarter was something like
14% QOQ.
14% QOQ, and so it's recovering from the cycle. I mean, I have really not compared with the numbers of other competitors in commercial vehicle segment, but we'll definitely look at that, and then probably we'll have internally we can understand that whether we are growing in line with industry or slower. But this commercial vehicle cycle has revived for sure. Collection has improved, and also the volumes have picked up very significantly. because it passed through demonetization, then there's BS found norms, then GST, and I think last quarter sector did very well.
But over in the rest of the segments, are you seeing some pressure points which have emerged very recently?
In which segment?
As in your entire loan book, any other product segments where you're seeing some kind of asset quality pressure or any collection related pressures?
So, what happens that if you really look at our NPAs that we give you product-wise or every category-wise, then except I think there's a little bit of spike in the construction, finance and real estate that you already spoken about.
Yeah.
And the second is in SME segment, where our book is growing. And, because we are now focusing on a smaller ticket loan, which is just about 10 lakh rupees. So there, the 90-day recognition many times creates a little bit of collection problems. So these numbers for the SME, but of course it's covered fully by pricing as well as our collection. So other than these two, if you look at all other segments, things are similar or they may have improved actually.
Correct. Thank you so much for it.
Yeah. Thank you.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Couple of micro questions. One was on the NBFC side, the other income.
Nischint, we are unable to hear you clearly, sir. Can you?
Yeah. A couple of micro questions. One was on the NBFC side, the other income. Just curious if there was any chunky item this quarter.
Not really, but let me look at the numbers. So on a smaller base, they may look into the percentage, but on the broader income, just 1 second, he'll give you.
65 going to 100 crores.
Granular detail in other income. Prabodh, just can you give them?
Yeah, so Nischint, so if you look at other income was up some 55% Q on Q, and this is due to few reasons. One, there is a sharp increase in our disbursement volume growth in retail products like home loan, gold, CV, MSME, MFI. If you look at the retail volume growth, it was almost 100% YOY. So correspondingly, my processing fee, etc., have also grown that way. That is not reflected in the AUM, but disbursement is very high. Secondly, there is a jump in the insurance income because many products now we are bundling, the insurance is in bundle with many products, including home loan, with CV, with MFI, SME. All these products are now being bundled with insurance and therefore jump in insurance income. The third is there is a capital market lending related fees have gone up because, that again, there the lending have gone up and therefore the fee income has been high on the IPO side.
Okay, capital market related income has, lending has fee income?
Yeah.
So what happens is there's some small processing fee when we do the IPO also.
Okay.
So some part of it goes in interest, but some part of it might go as a processing fee.
Sure. So would you guide us for a similar run rate going forward, or would you say that, look, there is some one-off to, so kind of,
See, because our growth is more driven by smaller ticket loan in MFI and MSME, where there is a relatively higher component of fee income as a proportion of total income. So you are right that the other income should now maintain higher levels as the retail business grows more in proportionate terms.
Sure. NPLs, if you could give the ratio on a like-to-like basis.
NBFC?
Yeah, that's right. NPAs.
NPAs?
Yeah.
NPAs are there on the slide.
Like-to-like basis. It's all like-to-like basis.
So they're all like-to-like basis? No, you are saying 90-day basis?
Yeah.
No, 90-day also, it's last quarter also 90 days.
No, this is saying on YOY basis or?
YOY, that's right. 90 and 120, I think YOY was 120, so.
Yeah. I think I won't have details ready, but on a like-to-like basis, things would not have worsened. In fact, most of the asset classes things have, improved. But just 1 second, give me a minute.
No, we don't have it.
Yeah, so we don't have those numbers, but if you look at the trend, then things would not have. I mean, we can get that number out and send it to everybody.
Sure. The other thing is on the developer loan, NPL rise. Just curious, how many accounts would these be?
Which have incrementally become NPA in this quarter?
Yeah, that's right.
About 4 to 5 accounts.
Okay. And just on the if I look at the overall capital, your capital market related income, that's been sort of almost flat for last 3 quarters. So, I mean, I would have thought that this quarter should have been far better quarter, or the income should have been much higher. So I was just wondering whether we are missing any trend.
So when you compare a YY basis, then there's some decline in the depository income and our delayed payment charges income also, which comes in, which has been part of last year's this thing. Also, the investment banking and cross-selling income, they're booking, and that becomes slightly erratic many a times because they become lumpy when the way they are booked and accounted.
Yeah, but I think
if you look at the mix of the business, that in terms of sometimes the volume growth that happens, that's more intraday and less delivery based, so that also causes income to grow at a slower pace. But there are various components of it. So, it's and also insurance and all those businesses we have scaled down significantly, and that has also resulted in cost saving.
Yeah, but I would assume that broking itself is a fairly large component in capital market activities because
there's no doubt about it. So, but as I said, that on a like-to-like basis, there are various components of depository income, delayed payment charges, investment banking, and cross-sell. So, broking per se, equity volume, and also there are commodities and currency brokerage also. So, there are several components.
Sure. Just one final.
Will not be, will be significant, but will not be the dominant part of it because there are several small components in that.
Sure. Just one final question and this is for Karan. Just trying to understand 2 things. One is A, seasonality in the business, and B, more importantly, what happens if, market crashes or, market remains weak for a fairly prolonged period of time. Your ability to cross-sell real estate or some of the other assets.
So if you see, I'll answer the second question first and I'll come back to the first one. So typically what we've seen over the last, I've been doing this for the last 20 years, typically what we've seen in case of steep market corrections, typically unless you've done really something fairly aggressive or you had some disproportionate allocation to something, you typically don't end up losing too many clients. So most of the clients typically shift their assets away from equity to fixed income or alternate products. If you see as a firm today on a gross 100 rupees, we have close to around about 53, 54 rupees in equities and around about 35 to 38 rupees in fixed income and 3 to 4 rupees in real estate and 4 to 5 rupees in other assets. So as a firm across client portfolios, the asset allocation is fairly tight and the volatility which we see on portfolios is not exactly similar to what we see in the equity markets. It's substantially lower. But yes, from a continuous ability to, or the ability of clients to participate in newer ideas can potentially come down a bit. Unlikely to lose assets, but definitely there may be a little less ability to see velocity of sales in that sense. Similarly, on the seasonality of the business, I think what may be potentially seasonal is the gross sales number. Now, obviously, out of your distribution revenue, a part of it comes out of gross sales for the quarter. A part of it is recurring trail fee-based income. So the recurring trail fee-based income is not really something which is that seasonal. The gross sales number can be potentially seasonal, which makes up typically 30 to 40% of the distribution fee. And that might come off 15-20% in case of a prolonged correction in the markets.
Sure. And no, when I meant seasonal, I meant on a quarter-on-quarter basis. Is it something that fourth quarter is strong or anything of that sort?
Not really. So it used to be, but now at this size and scale, it's pretty much now fairly evened out. If you see the last 6 to 8 quarters, in that sense, it's been more a Q-on-Q kind of growth. It's not really been a third quarter, fourth quarter kind of phenomenon.
Sure. Just one final question, and a lot of other finance companies or NBFCs are kind of setting up or trying to set up a wealth management vertical.
Right.
Have you seen competition, in terms of, on the employee side where they are kind of poaching employees? And second thing is, have you seen competition? Have you seen genuine competition in the ultra HNI segment that you're catering to?
So we definitely see competition both in terms of employees as well as in the terms of the platform. Employees, I think, as I said, both our senior bankers as well as our product and investment teams been fairly static, and attrition's been super low. I think a part reason for that is what Nirmal spoke earlier in terms of a very strong entrepreneurial culture, and a lot of our senior relationship bankers as well as senior employees owning stock in the firm and being around for the last 7 to 8 years. So I think in some ways it's something which is expressed very strongly as a culture, and we are still continuing to be able to attract conversely a lot of people from other platforms to join. Over the last 6 months, we had some couple of very interesting teams join us, and we expect a couple of very interesting teams to join us over the next 3 to 4 months also. In terms of the platform itself, there will be obviously newer kind of houses coming. As of now, we've not really seen a very strong new institutional player in the wealth market, but it cannot be absolutely ruled out because from a business perspective, really, one, obviously people are extremely important. And secondly, getting the platform right also needs today a lot of time, energy, as well as capital investment. So it's not easy to get the full formula right, but as of now, we've not really seen a large player come in. But we've got 3 or 4 names, as you're all well aware of, putting in a lot of energy, time, and capital into the business. So we'll have to wait and see over the next 6 to 9 months how these platforms shape up.
Right. Thank you. Next question is from the line of Shiv Kumar from Unifi Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, my first question is with regard to the NBFC. Now that we have seen that the microfinance loans have reached 574 crores, which is a growth of 42% quarter on quarter, what are the near-term targets you have for this particular segment?
So it's on a very small base, so it can continue to grow at a very fast clip. I mean, it's difficult to put quantitative target. I mean, I can't make a forward-looking statement on that, but our distribution network, our footprint is so large, and the whole idea of acquiring a small company was that we can expand the leveraging our distribution network, our managerial and as well as our branches. So I mean, it will continue to grow at a faster pace, at least in the next few quarters.
Right. Sir, and coming to this construction real estate segment, again, revisiting the increase in the NNPA, I just wanted to understand at what stage of the construction do you actually get in? Is IIFL taking the construction risk of the project also on board, or do you actually get in towards an advanced stage of construction?
No, so I mean, the construction risk of the project, the execution risk of the project is always there as a part of construction finance. But what kind of approval risk we take is, so what happens that, we try and make sure that all the approvals, all the titles are in place. But under Indian law, many times what happens that even when the approvals are given, and there's a very large project in Mumbai which has become a showcase example of that, then even those approvals are challenged right in Supreme Court by saying that the concerned authority did not give those approvals properly, and then also project can get stalled. So the litigations can happen at any stage, which no amount of diligence can actually prevent it. But we try and make sure that all the approvals are in place before we lend to the project.
All right. Sir, and my second question is related to the wealth management segment. We see that the retention yield has been given as 92 bips, of which 26 bips is from the fund-based activities. So this 26 bips is basically, is it being calculated on the wealth NBFC assets? When you say fund-based activities?
No, the retention yield is being calculated on the entire asset base of 1,22,000 crores.
Okay, leaving out the offshore FPI, that's it, right?
That's right.
Okay, and what explains the dip in the retention yield from 98 bips in FY17 to currently 92 is the run rate which we are looking at on a quarter-on-quarter basis? What explains that?
Mostly mutual funds. So effectively, mutual funds have all moved to trail. And what essentially last year, the only mutual fund which in that sense kind of gave an upfront recognition was fixed maturity plans. Otherwise, all other kind of mutual funds, which include all equity fixed income mutual funds, are all on trail basis. So FMPs have become a much smaller portion of the mutual fund mix. So that's mostly the reason for the dip.
Right. And isn't this steady state current? Can we assume that this will maybe steady at these levels?
See, world over retentions, including fund-based and non-fund-based, have been in the region of around about 72 to 80 basis points. So I think in the longer term, with a larger base, I think it's fair to assume 70 to 80 basis points. And typically, fund-based income should be in the region of around about 25 to 30% of the overall revenues. And 70 to 75% should be fee-based.
Right. And coming to your hiring plans, now that you have grown by 34 bankers over the last quarter, so in the medium term, what is the guidance like?
So it's really a function of getting some good bankers. We've seen a lot of growth in some of the cities we are not present in, because right now we were only there in around about 11 to 12 cities predominantly. We've seen 6 or 7 cities do extremely well for us on a hub and spoke basis, which we've been operating for the last 12 to 18 months. So we expect to add a banker each in these 6 to 7 cities. And Bombay, Delhi, Bangalore, Calcutta, Chennai, I think we would end up adding around about over the next 6 months another 35 to 40 bankers. So I think in total around about over the next 6 months, around about 50 bankers is what we are potentially looking at.
Thank you. With follow-up question from the line of Viral Shah from Credit Suisse. Please go ahead.
Hi, thank you very much for allowing the follow-up. Sir, just a couple of clarifications again on the demerger process. In the past, when we've seen other listed companies go through this, we have noticed that there would be a period when the holdco is delisted and there's nothing trading for a while, and then the other businesses list. Is that how it's going to be, where there could be a gap in trading?
At least at this point in time, the way we have envisaged, there won't be any gap in trading of the company, but what will happen is the NBFC will get merged with Holdco. So Holdco will continue to trade, and at some point in time, that will become the NBFC that is being traded, and the other two companies might get listed in a week or two. Typically, I think this gap, if you manage it, all the compliances properly, can be about 10 to 12 days.
Okay, understood. Thank you.
What will happen that Holdco on a particular record date will become a NBFC but may continue to be listed, and the other two companies will get listed with a gap of 1 or 2 weeks. But this will happen maybe 8-10 months later when all the approvals are in place.
Got it. And secondly, Prabodh, going back to the question on the high other income. What we notice is that there actually seems to be some restatement as well. I mean, because even in the previous quarter numbers, other income is higher than what it was reported in previous quarter's presentation. So is there some reclassification from revenue from operations to other income?
Yeah, so that is a reclassification which is happening. We had a change of our auditors in the last quarter. Deloitte has become our new statutory auditor, and therefore they have certain views on the classification of various income and expense items. So therefore we have had some regrouping in the last quarter and as well as in this quarter. And I suppose that there will be some reclassification in the next quarter also. But probably from the first quarter FY19, there should be no more. All the major classifications should have happened in these 1 or 2 quarters.
Understood. And last question. The home loan segment within the lending book has been growing and about 27-28% total. Where do you see that going up to over the next say 2 to 3 years, and what would that mean for your margins and your ROAs? Thank you.
So, home loan, our market share in the home loan or mortgage market is very minuscule. But if you look at our distribution network, it's much bigger than what our market share is in home loan. So, logically this business should continue to grow at a faster pace. What it does to margin, that in the short term, it impacts our margins downward. It affects our NIM. As you can see that the fall in cost of borrowing is not fully reflected in NIM, primarily because home loan is becoming a larger share of our portfolio. But with a give on that 12, 18 or 24 months gap, it works out very well because there are 3-4 reasons for that. One is that home loan, you can get it refinanced by NHB at a fairly attractive rate, and so you book your income as well as you release your capital. You can sell down your portfolio to banks because significant part of our home loan portfolio classifies as priority sector. And even if it's non-priority sector, there's very good demand for home loan portfolio. Thirdly, in home loan and the HFC, your capital adequacy requirement is lower. So it's just about 12% as compared to 15% in NBFC. And also, most of the home loans that we do are small ticket home loans. Our average ticket size is just about 22 lakh rupees. So they classify for a risk weightage of 75%. So effectively, this 12% capital adequacy becomes 9%. So that also gives you an advantage and you can leverage more. So from ROE perspective is good, but in the growth phase, it might have some dampening impact. But as the book becomes larger and stabilizes, then it reflects very well in the ROE.
Okay, that's helpful. Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Thank you so much, everybody, for being patient. And if you have any more questions, you can always write it to Pooja, who handles our investor relations, and you can be in touch. Thank you very much. Bye. Have a good day.
Thank you very much. Ladies and gentlemen, on behalf of IIFL Holdings Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.